everyone. This is Elizabeth from Keller Williams, real estate agent with 20 years experience, and I have Cody Touche from Movement Mortgage, 25 years experience. Cody, can you tell us a little bit about you?
Yeah, you bet. A little bit about me. Born and raised in the Pacific Northwest, so always lived in this area. Went to school in Western and got a degree in finance. Always knew I wanted to do something with money and numbers. Kind of fell into mortgage, and 25 years later, here we are.
All right. Well, it's been a roller coaster, I will say.
Yeah.
And we want to talk about everything that we've seen in the last year in the mortgage industry and real estate, and have questions for you, Cody.
Sure. Yeah.
If the mortgage market were a mood right now, what will it be and why?
Yeah, a mood. I guess I would have to say undecided, right? That's the undecided. We'll get some news that we think would drive interest rates lower and they just don't move, right? Or we actually see a Fed rate cut and they cut the Fed funds rate and then long-term mortgage rates go up that day, right? So we'll see we'll see a nice reduction in interest rates when there's no news at all, right? So it's really hard to tell what's pushing things around right now, and I think that there is a little bit of pent-up market move. I think we'll see interest rates get better this next year. Just hasn't happened yet.
We should hope so, right? The buyers are like waiting for that time. When is the best time? What do you think? When is the best time to buy?
Oh, well, that my favorite saying is, when's the best time to plant a tree? 20 years ago. When's the second best time to plant a tree? Right now, My thought is if somebody's financially ready, now's a great time to be a buyer. And the reason why is if you wait until rates come down, then I think prices are going to go up, right? It stands to reason, right? If it becomes less expensive to buy something from a financing perspective, that the price of that thing, whatever it is, car, house, whatever, will go up. And so if you wait to buy right now, we've done the math. If you wait to buy right now and rates go down 1%, you might think, okay, sweet, I want to go buy. Problem is, you and everybody else thinks the same thing, right? They want to go out and buy as well. And so if rates come down 1%, but the home price, because of competition, goes up by 10%, it's literally the same payment.
Right.
The payment is exactly the same if the price goes up 10% and the rate comes down 1%. So instead, buy now, and again, it's got to be the right house, got to be financially able, but if you are able right now, buy now, and then come back and refinance your interest rate when the rates come down. That way you set your price, we know exactly what we're paying for the house, and then we're going to lower our interest rate. Lowering that interest rate will lower the payment by about 10%.
Right. I always tell my clients, if you're ready, you're ready. Why wait, right?
Yep.
Mentally, the buyer also has to be ready, believe it or not.
Absolutely, yes.
I have buyers that 6 years ago, they're still waiting for the interest rates to go down, but when they went down, the market is too hot. I'm going to wait.
Now there's nothing to buy.
And
the market's too hot.
And then what happens? Then the prices went up, and it's like, is it really the perfect time to buy? No, it isn't.
That's right.
If you can afford it, do it.
That's right.
That's what I say.
Yeah, and I always tell people that too. If you've got the means and the ability, and the market does come down, right? I think that's what people are worried about, is making a mistake.
Right.
And if you make a mistake and home prices go up and rates come down, and you say, well, hey, I should have waited to buy, you can always fix that mistake with a refinance. If you buy a house and the value goes down, then it feels like you made a mistake.
Right.
But I've bought houses, I've bought in lots of different houses, and the longer I'm in them, the smarter I look, right? So if we're thinking about buying this house for 10 or 20 years, there's never been a 10-year period of time where real estate's down. From year to year, sure. Right? And if you want to try to time it and day trade your house, right? And time the market and get at the very bottom, well, then you're a better man or woman than I, right? Because I've been in this business 25 years and I don't know how to do it, right? I don't know how to time the market. Right. But I know that time in the market beats timing the market.
Right. We started over 20 years ago. I did too. Back then, interest rates were, what was it, like 80-20, 6%, and the other one was 10%. People were buying. They never thought about, the interest rate is too high.
Yeah.
So right now, for some people that, the interest rate is too high, I'm kind of like, no, it's not. It's normal. It's back to normal.
This is
normal. So people got a little bit too, I would say, with the 3%, the 4%, you
They were
know.
spoiled.
That's exactly the word that I was
Yeah.
looking for. We were spoiled,
Yeah.
and whomever took advantage of that, great.
Yes, absolutely.
But if not, we're back to normal. That's what it is.
Yeah.
But we're back to normal. But
We are back
anyways.
to normal. That time that we spent below even say 5% was really only leading up to and in the pandemic, right? And anything under 4% was just plain pandemic, right?
Right.
And that's hopefully a once in 100-year sort of thing, right? So if you're waiting for those rates to come back down, I think you're going to be waiting for a really long time. If not, it'll never happen. And there's always ways to talk yourself out of making this kind of purchase, right?
And then the bidding war happens again.
Right. Exactly.
Yeah.
But the net worth of homeowners is through the roof compared to a renter, right?
Right.
And my thought too is to take that next level is it's great to become a homeowner, but then down the road maybe we're even an investor beyond that. Maybe it's a second home or an Airbnb or just a long-term rental. But the more boats you have in that ocean as the tide rises, it will create more and more wealth.
Okay, that's a good. I just thought about this question, Cody. You do loans in other states.
We do, yeah. So I was involved in the foreclosure auction and buying short sales here in the Pacific Northwest for a long time in the downturn, right in the correction in 2009, 10, 11, and then things got very competitive here, and was tough to make a return. So we started helping investors in other states, right? So started with local, Oregon, California, Idaho, but now we're spread all the way across the country. So
That's good.
35 different states we're licensed in.
Perfect. That's perfect.
Yep.
Okay, the next question will be in one sentence. What do you do better that most lenders out there don't?
Great. I'll do one better. One word: creativity. I feel like me and my team we're very creative. We always find a solution. We've got a mountain of different products that will fit for whatever somebody needs. And with us, it's never a no. Sometimes it's a not right now, and here's what we've got to do to make a plan to get there.
Right.
But our creativity is off the charts. Awesome.
And get the buyer ready in case if it's not ready right now, or for some reason something is missing for the buyer to be able to get a loan. You communicate with them and
Yes.
guide them through the process. You just don't forget about them.
Correct.
That's
Yeah.
why I'm doing this video with Cody, because I know he is amazing.
We've had clients on credit programs and savings programs for 2 years to get them ready. So
Right.
we just
Yeah.
check in on a regular basis. Life happens, things change.
Follow-ups.
Yes,
Yeah.
follow it up.
What's the number one mistake you see on first-time buyers that make before talking to a lender?
Yeah, waiting too long, right? Like they want to just get everything just right? I got to fix my credit. I need to save up some money. I need to do this. I need to do that. You don't need to do any of that, right? Everything that we do is free. I only get paid if we close a loan. And so there's no harm, there's no danger in having an early conversation. I love to meet with people that are a year out. They think they're a year out.
Right.
Sometimes they're not a year out, right? We get them ready faster. But if they say, hey, I'm a year out, I'm like, awesome. Let's make sure you're good. We take a look at credit, make sure we're in good shape. I can't tell you how many times we've pulled credit. There's something on there they didn't know about. They waited, and now they have to have this house on Saturday, and it's Saturday morning, right? They need to get an offer in before the open house at 1, and their credit's not there, right? But we had been talking to them for a month before, and they weren't ready to pull that credit. Let me pull the credit. There's no harm. There's no foul. There's no charge, right? We look at it and we can make a plan. One, confirm you're great. 2, find out something you didn't know about. 3, find something you did know about, and maybe it impacts you more than you thought.
Right.
So getting that early is super important. Credit piece, very important. But then also how your income's calculated. Sometimes people will come in and say, oh, I make $200,000 a year. I'm like, great. Give me your pay stubs, bank statements, tax returns, yada yada, all the things. And let's say they're a plumber, and they gross $200,000 a year, but then they have expenses, and they have an employee, and they net $40,000 a year.
Yeah.
That's a totally different qualification.
Right.
Right? Or, like maybe they're making $200,000 a year, but it's a brand new position. Or it's a lot of it's commission or overtime or bonus, and there's different rules about how we calculate those things. Not saying we can't calculate them, but maybe it looks a little different for you as the person that's bringing in a big check every month, but hasn't had a big history of it, right? So I'm going to look at things a little different in the mortgage space.
Okay.
So there's lots of different assets too, right? Somebody that's just inherited a big chunk of money. I may not be able to count that right away. Maybe we need to call it a gift. Maybe we need to look at it. Maybe we let it season for a couple months. There's a number of different things that could hang somebody up versus how a consumer looks at their credit, income, and assets versus how a mortgage lender is going to look at it.
Right.
So just not doing it early enough.
When I talk to my clients, I kind of try to get a little information about, okay, this is the situation, we need to talk to a lender. The biggest mistake I see is they call me because the landlord gave them the notice and they need to move out in a month.
Right.
There is really not much we can do in a month.
Yeah. Not if you need to do some work, right?
Right.
Yeah.
So get ready. What would you say? 3 months, 4 months at least before that rental
Yeah.
agreement expires?
You
and get ready.
Yeah, if you know you're in a lease and you've got 6 months left on it, you're going to want to make a move. Let's talk about it.
Get ready.
Yeah.
And the other thing that I heard a lot from my clients is like, oh, I don't want my credit to go down. They're gonna pull the credit. The points are gonna go down.
Yeah.
What do you say about that? How many points? You know, what is
Great
it?
question. Yeah. So a lot of times, most people that say that have really great credit scores and they're very guarded, and that's why they have great credit scores because they've been guarded about the credit, and that's awesome.
Yeah.
And for somebody with a great credit score, a mortgage rated pull, 1 to 2 points. Right. So if you're at 812, you might be at 810 when I look at it, right? And maybe 0, right? It really could be nothing. Somebody that doesn't have great credit, we need to pull it, right? Even if it does go down a couple of points. Again,
Right.
no more than a couple points. But even if it goes down a couple points, we need to pull it because the credit score and your history are very important to qualifying. We also do have a soft pull, right? So a soft pull is just one bureau and it doesn't hit your credit score. So it doesn't hit, there's no record of it. It does not provide a credit score change. It gives us one bureau, one score, and a look at your liabilities. So if you're 6 months out and we're a little hesitant about where our credit might be, the soft pull is a great way to get a look at it.
Right.
And if it's not great on there, then maybe we do a full pull, look at all 3 bureaus, look at everything, and then get to work, make a plan.
Another mistake with a lot of my clients, business owners, they have the down payment under the pillow or
Sure.
under the mattress,
Yeah.
like we said.
Coffee can in the backyard, mattress money.
Right. What do you recommend? How often what is this about buyers having the money out of the bank account?
Yeah. So from a mortgage perspective, we have to source and season the funds, right? We have some fiduciary responsibilities about money laundering, right? That's really what it comes down to. And not that I would expect any of our clients are money launderers, but I got to follow the rules, right? And so the rules are I need to provide 2 months worth of bank statements, and any large deposits have to be sourced and seasoned. And sourcing and seasoning can't come from a coffee can or a mattress under money on the mattress, right? So a couple ways to make that work for you, right? Is again plan early, go down to the bank, deposit the money,
Right.
get it in there for a couple months, and then let's say you put it in December. Your January statement's probably going to show that deposit, but your February statement will not show that deposit, and your March statement will not show that deposit. So if we're 6 months early on a lease renewal, and we have this conversation, and you say, "Well, my money's in the mattress," I'll say, "Put it in the bank, right? Put it in the bank. Wait a couple months, and then give me those statements, and then I don't have to source it."
Right.
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 Now, another way to get around that too would be a gift, right? So if a family member, mom, dad, grandma, grandpa wants to give you a gift for your down payment, totally acceptable. Almost every loan type.
What's the max for a gift? I remember having this conversation with you about a week ago with
Yeah.
a client. Gifts.
So gift funds, a lot of people think there is a limitation to gifts, and there's not in the mortgage world, right? Now there's a limitation for IRS, right? The federal government has a limitation of what you can gift to a person per year, and it's per person per year, and I think it's like $18,000. Okay, so but if mom and dad want to gift to, let's say, son and daughter-in-law, that's 4 people involved. So mom to son, mom to daughter, dad to daughter-in-law, dad to son. So that's 4 times the gift limit. Now, that's the IRS maximum per year to be able to not count it towards your lifetime gift exemption, which is like $2 million.
Oh.
So like a lot of times people are like, "Oh man, I gotta hold to the gift limitation." Great, and that's fine, but it's not a limitation from the mortgage company, and the IRS has a lifetime gift exception, and it's a huge number. So
Yeah.
there's really not a limitation to
Will
gifts.
that depend on the program? FHA conventional doesn't matter?
Yeah, very good question. So FHA, conventional, VA, USDA, they all allow gift programs. Jumbo loans, oftentimes, and that's generally speaking, think about anything over $1 million, right? A jumbo loan's going to have a requirement that at least some of the money is from the borrower's own funds. Typically, it's 3 to 5%. So on a jumbo loan, usually the down payment's like 20%. So if somebody says, "Well, hey, I have 5%, but I don't have 20," mom, dad, grandma, grandpa, they can help with 15. They put in their own 5.
Okay.
Yeah.
That's good to know. What's the biggest surprise buyers have once they start the loan process?
Oh, yeah. I mean, honestly, I think the biggest surprise is how easy it is, right? I mean, everybody thinks it's really difficult.
With you.
Yeah, well, okay, fair
With you.
enough. Fair enough.
With
fair
you.
enough. We
Yeah.
try, we do our
Yeah.
best to make it easy, right?
Yeah.
So we are very thorough up front. So I guess I would say a negative surprise, right? A surprise they don't expect that's not a really great one is all the documentation we need, right? So pay stubs, bank statements, tax returns, you know, a gift letter if we're going to do a gift, photo ID, mortgage statements if you already have a mortgage, lease statements if you own rental properties, right? It's a big divorce decrees, child support orders, all the things, right? And the reason why we get all that stuff up front is because we don't want any surprises later.
Right.
Right.
Or
And so-
stress with the buyer.
Right. Yeah, exactly. Surprises later, stress can come in. If I get all of that stuff up front, then there's no hiccups, right?
Right.
We've already done all those things. We've crossed all the bridges. There's not something the underwriter's going to come back and say, "Hey, I need this," and they're not going to have it, right? So that would be a surprise. Is the doc? Because I hear this a lot, right? "Hey, here again, send me all this stuff. Send me the application." "Oh, I just want a pre-approval." I'm like, "Well, I understand, right? Though I know I'm ready to apply for a loan." I'm like, "Well, that's what we're doing, right? We're applying for a loan. We're not granting you one, and you're not necessarily taking one.
Right.
But the application is the application. And if we don't get all these things now, we will have to get them all later. And if I get them later and there's a surprise,
Right.
you may not be qualified at all,
Right.
So getting all that stuff is super important. And then on the positive side, I think it's easier than they think.
That's the thing that I see with buyers. They get frustrated because why are they asking me for this? Why are they asking me for that? Well, they want to make sure that we don't have a hiccup at the end of the transaction and everything falls apart.
Yes.
Right?
We're trying to bulletproof your transaction, right? Because here's what happens, right? Is you make an offer and you write a check for earnest money. That earnest money is at risk the minute you do that. And so if we can't comply with the loan terms and get you that loan, you may lose your earnest money. Not, which is bad, right? Because sometimes earnest money is $5,000. Sometimes it's $50,000. Nobody wants to lose $50,000, right?
Yeah.
But then the other piece of that is, especially if it happens late in the game, you've given notice at your apartment. You're homeless in 3 days, and we can't close on this new home, right? And now you're like, well, shoot, where do I sleep, right? It's one thing to lose 5 or 10 grand, no good, but you'll recover.
Right.
But if on the 31st you're out of your house and you've got no place to go, then what do we do, right?
Right.
That's a really tough spot for everybody. That does not happen, and I don't want it to ever happen.
The thing with pre-approvals, and this is what I also recommend my clients, sometimes they come with a loan ready. I'm already pre-qualified with whatever bank.
Sure.
I recommend shop around a little bit, compare bank from Cody.
Yeah.
Why? Because it can be different, right?
A bank has the bank's products. We have lots of banks products because we work with tons of banks. We have like 45 different investors and multitude of different products. And so you go to Bank of America, Bank 1, Bank 2, Bank 3, whatever, Bank whoever. They're going to show you all the Bank whoever products, but they're not going to show you Bank number 2's products or Bank number 4's products or like a specialized mortgage company. There's banks we work with that don't have a corner location, right? They just do mortgage, and they only do it through a conduit like us. So you couldn't go get that at Bank 1, Bank 2, Bank 3, right? So you're very limited on the product scope that you have at a bank or a credit union. When you come to someone like me, we've got a big, wide array. And so what I would say is the fact that somebody's already been through that process is great, right? You took the first step, that's awesome. And maybe we don't know who that person is or that bank doesn't ring a bell. So there's no harm, there's no cost, and there's no obligation to letting us take a look at it as well and kind of run alongside, right? So if we're running alongside in this relay race and bank number 1 drops the ball, right? They drop the baton and now the race could be over. But if I'm running right alongside of them, I can just reach over, pick up that baton and close on time.
Right.
And save the day, right? And I'll tell you, we've saved some days.
My experience with banks, Cody, I get clients that a bank approved them, and I ask my client, did they ask you for such
Yes.
documents before they say you qualify for this amount. Oh no, but they told me based on my deposits and all that.
Right.
So they didn't run credit, ask for taxes, ask for pay stubs, and
Yep.
they tell the client, "Oh, you qualify. Go find a house."
Yep.
When they don't.
That's right.
I will say in about 20 years, 3 transactions fell with Bank of America
Okay.
because they never asked for these documents upfront.
Yeah.
But anyways.
And we see that, and that's you're way better than average realtor, because a lot of times realtors don't ask that question. They just see that pre-approval. They're like, "Let's go buy a house," and then all of a sudden it unwinds, right? And so, and that's the thing. If you can hop online, punch a few buttons, and get a pre-approval letter, run. Right, that is not a pre-approval letter, because
Right.
a true pre-approval letter has been backed up by tax returns, pay stubs, bank statements, everything.
Right.
That's a pre-approval letter. Anything else, not really what
Right.
it says. Yeah.
So, well, they can always call you for a second opinion,
Always.
right?
You
Yeah.
bet.
All right. Well, if someone's credit is imperfect,
Mm-hmm.
is that a deal killer or a starting point?
Yeah, not a deal killer, right? A lot of times people think, "Oh, I got to have a 750 credit score to buy a house." It's just not true, right? We have products down as low as a 580 credit score, right?
580.
580 is pretty low.
Okay.
And what I would say is, most of the time, if we take in a new client and they've got a 580 credit score, by the time we're finished, their score is over 620, right? Because we can look at some things and do some things and massage that data around a little bit, pay off a credit card,
Help them.
maybe open up a new one, right? It might be that they don't have enough credit, so they have a low score. We can help them bring that score up. If it's under 580, then it's a starting point, right? It's like, hey, we're not there yet, but here's the things that I would recommend we do to get there, right?
Right.
So, could be paying down some credit card. It could be opening up a new one. It could be that maybe we've got an old collection that needs to be taken care of. Maybe there's some things on there that don't belong. I mean, we see that all the time. The
Yeah.
credit agencies, there's nobody really policing them, right? So you have to police your own credit. And so if something on there that doesn't belong, you've got to challenge it and get rid of it.
And that's the thing with clients. I tell them, well, how do you know your credit is good? Well, I think it's good because
Yeah.
I pay on time. But once their credit is full,
Mm-hmm.
they find collections that they never knew about.
Yep. It's happened to me. I had a doctor visit, and I went, and they had an old work address that I hadn't been at for 3 years. That's the only place they sent mail. Finally, I was applying for a mortgage, and I saw this collection. I got no telephone calls. I got no forwarding email. I got no forwarding mail, and I had to find out through a mortgage poll that I had a $300 collection for a medical bill that I didn't know I had. Called them up, and I said, is this me? Like, it's you. I was like, well, I want to pay it. I had intended to pay this. Where did you send the bill, right? We came to it. They sent it to some address I hadn't been at for 4 years,
It
right?
takes a while to fix that, right?
Well, so in this case, and this is a bonus tip, right, is I had the collection. So I called the doctor and I said, hey, I never got this bill. What's what? And they said, well, it's with collections now. You got to call them. I'm like, oh, geez, okay.
Yeah.
So I called the collections company, and this is the advice, right, is I called them up and said, hey, this is me. I'd like to pay it, but I'd like this collection removed.
Right.
That's key.
So you can request that.
And you can request it. And a lot of times, so the bonus is the collection companies, if this was $300, they didn't pay $300 for it. They maybe paid $100 for it, maybe
Yeah.
$50 for
Yeah.
it. And they bought it in a big batch, right? And so they're hoping to get something. And so when I call them up and say, I'm willing to pay the entire bill, the alarm bells are going off. They're like,
Right.
hooray, this
You're
is great.
making money.
Yeah, exactly. They're making big money. But I said, in order for me to pay this, I need you to delete it. So they call that in the biz, pay for deletion. I'm going to pay this bill, but I want you to remove it. Not show it as zero balance. That doesn't help me. Remove the collection like it never happened.
Out of the
That's correct.
the records.
And she said, okay, I can do that. I said, could you send me a letter or and then she said, I'll do you one better. I'll send you an email right now while we're on the phone, because they didn't want to let me go, right?
Right.
They got me on the phone. I'm willing to pay.
Yeah.
They don't want to let me go, right? So they said, I'll do you one better. Here's an email. If you reply to
Get
this,
that in writing.
get it in writing. That's
Yes,
the point.
that's the thing.
Get it in writing. So I got it in writing, and I gave her my credit card number over the phone. We paid it. Within 10 days, it was off my report.
Okay, I was gonna ask that. I mean, you have to have something in writing. Don't
Yes.
pay anything until you get that.
That's
in
right.
writing.
Because if I said, hey, remove it, and she says, sure, and I pay them, I'll never get that gal back on the phone, right? There's thousands of these operators, right? I'll never get her back on the phone. And when I go to challenge it with my credit bureau, if they don't just remove it, they're going to be like, well, nobody said they were going to remove it. Like, get it in writing first and then pay them.
It stays there for years, I think.
It sure
That's
can.
All right, everyone is obsessed with the interest rates right now.
Yeah.
What should buyers really be paying attention on?
Yeah, so interest rate's important, and I don't want to downplay that at all. But I think the most important thing is, one, are you financially ready to buy a house? Are you mentally ready to buy a house?
Mm-hmm.
Do you have the money that's required for cash at closing, and can you afford the monthly payment?
Right.
Those are the main things, right? If you check all those boxes, start shopping for a house. The rate is a function of that payment, but the overall payment is the important piece, right? Because you don't ask your landlord what the rent or what the rate is, right?
Right.
What's the rate on what's the rate of interest on your rent?
It's 100%.
It's 100%.
Right.
So my 6% is pretty dang good compared to 100%, right?
Yes.
So would you like 5? Of course. But if it's at 6 versus 100, it's still pretty dang good.
Right.
And so again, if the cash to close fits and the monthly payment fits, let's go.
Right.
And then when rates come down, we'll refinance and save some money.
Right. I always said, do you want to pay the landlord's mortgage?
Yeah.
Or do you want to pay your own?
One way or the other, you're paying a mortgage.
Right?
Yeah.
Is it smarter to wait for rates to drop or buy when you're ready, financially
Yeah.
ready? Well, we talked about
I think
that
we did
already.
cover that one, yeah.
Yeah. Can someone buy an investment property if they're ready to own a house?
Yeah,
If
absolutely.
they already own a house, sorry.
Yeah, and that's actually puts you in a better spot, right? If you don't own a house, it's actually a little harder to buy an investment property. Not impossible, but a little harder. But yeah, if you own a home already, absolutely. So you could do one of two things. Sometimes people will turn their current home into a rental and go buy another primary residence, right? So if their primary residence maybe doesn't fit their life anymore, but would make a good rental, they turn this one to a rental, make the new one their primary. That's totally great. As long as you have a signed lease agreement on the one you're leaving, I can count the rent to offset your mortgage payment on that home, and then you just qualify for the new one. If you already own a home and you love your home, yes, we can absolutely go buy a new investment property.
Mm-hmm.
Typically, that would be for a single family home, you're like 20 to 25% down. That's a sweet spot. And the rate's going to be about 0.5% higher than an owner occupied home.
Mm-hmm.
But when you're buying an investment property, it does not need to be rented to count it as rental income. So we'll do an appraisal to determine value of the home, but in the appraisal we'll also order what's called a rent schedule. So they will go out and survey the marketplace and say, okay, that house rented for $3,000, that house rented for $3,200, that one rented for $3,500. We think the rent on this one should be $32,000, right? And so then will allow us to count that $3,200 a month in rent to offset the payment on the new mortgage to help you qualify.
Right.
Yeah.
With having a house already and they're buying another one, they move into the other one to be the primary residence. Is obviously the less down payment.
Correct.
The requirement. Is
Yeah.
there a distance requirement for that?
Great question. Yeah. So if you're going to move from your current primary residence to a new primary residence, generally speaking, 5% down would be the minimum. And I will say I have helped people buy houses that are very close to their existing home, but it has to make sense, right?
Yeah.
So if the house they're leaving is worth 1.5 million and the one they're buying is worth 800,000, and they're keeping the one for 1.5, underwriters probably going to really question that, right? Vice versa, if you're selling a house or renting a house that's 800 and buying one for 1.2, 1.3, well, we're going up, we're getting more bedrooms, we're getting a more luxurious house, what have you. That makes a lot of sense. So if we're going down, then we've got to make a case for it, right? And it's not a no, it's just we're going to have to make a case for it. So
Right.
maybe the kids are gone and they're downsizing. They want to keep that house because someday maybe they want to let their kids move in or
Right.
what have you, right? Whatever it is. But if they're downsizing for a legit reason, then we can sell that, right? That
Right.
can work.
Okay, that's good. Let's see. Tell us about a deal everyone thought was dead, but you made it happen.
Yeah, well, there's been a few of those ones. I think probably the one that's most recent came to mind was we got tax returns in and they were just not what we were expecting, right? They kept telling us that, oh, I make this much, I'm good, I make this much, I'm good. I'm like, okay, but I don't advise you to go out and start shopping for a house until we see them, right?
Right.
And so we get the taxes in, and sure enough, they're not what we expected, right? And the assets weren't there, and it just was a giant mess. And so we pivoted to a different type of product where we didn't need tax returns, right? So this one was this turned out to be a short-term rental vacation home that we used DSCR funding on.
Okay.
Okay, so the DSCR stands for debt service, fancy way to say the mortgage payment, coverage ratio. So as a function, that means how much rent does it bring in versus how much is the rent payment or the mortgage payment, excuse me. So if that meets a certain threshold, then we can go forward with no tax returns, no job even. You don't have to have a job.
Bank statements.
So different than bank statements. So this is an investment property only. So it looks at the new rental income on the new property, compares that against the current or the new payment on the new property, and as long as that meets typically it's a 1-to-1 ratio. So if the new mortgage payment's gonna be $10,000, if the rental income is $10,000 or more, we're good. We don't need taxes. We don't need a job. We just have to verify credit and assets. That's it.
That's cool.
And so that's what we did. This one was gonna be, it was a big house, $1.7 million, but the rental schedule came in at $21,000 per month for a short-term rental. So that was enough to get us qualified to what we want to do.
That's pretty cool.
Yeah.
All right. Well, we talk about why buyers should talk to a lender early,
Yep.
to avoid the hiccups and last minute losing earnest money because something happened.
Yep.
So that's the kind of loan, because this was the other question. What kind of loan do you recommend for buyers that have not filed taxes or don't look great?
Yeah, that's a great question. So that program that we just highlighted, the SCR, is excellent, but it only works for investors, right? So if you're buying a new primary residence, that doesn't count. So a primary residence, we can look at, so somebody that either hasn't filed taxes or maybe the taxes, they write off a lot, which, hey, more power to you. Get those IRS tax write-offs, right? That's
Right.
good. But there's a famous saying, you can't have your cake and eat it too, right? You can't write off all your income and then show all your big income to buy a house, right? Those don't match.
Right, yeah.
So the cake and eat it too program is what we call a bank statement loan product, right?
Okay.
So basically what we do is we don't look at tax returns. So your income is calculated from your deposits in your bank statement. So we've got a couple clients right now that are doing this. They're self-employed. They bring their money into their business bank account from their sales of whatever they're selling, right? I don't want to give away too much detail, but whatever they sell, they get their income, right? They bring that income in, and so we look at 12 months worth of bank statements, look at all the deposits, add those up, and then we give an expense ratio. So it depends on what they do. The expense ratio could be between 30 and 70%. It's like 70% would be like a 7-Eleven owner, right? Where their cost of goods is high, right? Or it's very high expense business. Now there's other like I've got a client that right now that has a very low expense ratio, but we're using 50% because it's generic, right? So if she brought in, let's say $50,000 a month, I would say $25,000 goes towards expenses, and the other 25 is income. That's money we get to count towards offsetting the monthly payment. Okay, so I've got one of those literally closing this week, where we looked at the taxes and we're like, you don't qualify right now, right? Now, if you wait until 2025 and file your taxes, I think we're in good shape, because the thing is that business really took off in the last 12 months. 24 months ago, wouldn't be there. If we had to do a 2-year average of bank statements, wouldn't work. 2-year average of tax returns, definitely wouldn't work. But the last 12 months were great for deposits. We can qualify with just those.
That's pretty awesome.
Yeah.
The majority of the first-time home buyers don't understand the zero down payment program.
Oh, yeah.
And this is really good for first-time home buyers, because we talk about loans with 20%, 10% and all that. But let's talk about first-time home buyers, zero down payment programs. What can you tell us about that?
Yeah, that's probably one of the biggest misconceptions in the business, is that you have to have 20% down to buy a house, right? A lot of people think that. It's just not true. And it was true, right? So a lot of myths come from maybe a half-truth or something that used to be the case. Before mortgage insurance was invented, 20% down was a requirement. Mortgage insurance has been around for 50 years, right? More than that. So with mortgage insurance, you're now covering the most risky part of the mortgage for a lender, which is that top 20%, right? The payback of the first 20%. So with mortgage insurance, we can do 10% down. We can do 5% down. We can do 3% down. Or with certain instances, we've got this Washington State Housing Finance Commission movement. We have our own proprietary product that allows for, basically what it is a down payment assistance. So it's still either a 3.5% down FHA loan or maybe a 3% down conventional loan. But then what happens is this other organization, the state of Washington or movement, will give you a 3, 4, or 5% loan to make up the difference. So it's 100% financing, but it's over 2 loans. Okay, so it's still a kind of a generic FHA loan or a generic conventional loan, but now you've got this stacked second mortgage behind it that allows us to do 0 down. Of course, if you're a veteran, thank you for your service. Veterans are allowed to do 0 down. That's not a problem. If you're buying in a rural area,
the USDA
is a product. Now they're a little more particular with debt ratio and credit score and a few things, but a great product if you're in
the
rural
area.
In the area, it's a geographically restricted program.
Right.
So is Washington State Housing Finance Commission for that matter, because it's Washington State, right? You couldn't buy a house in Oregon and use that. But most states have their own down payment assistance programs too. So that's a really great way to get in. And like sometimes people come in and say, hey, I got like $5,000, can I buy a house? The answer is yes, right? Because that's earnest money.
Right.
That's the money you need to have. You need to have earnest money. A couple $1,000 at least. We can get your down payment, we can get your closing costs covered by the seller, we can get your down payment covered by the state or maybe our movement down payment assistance, but you just don't have to have a big chunk of money for down. Right. And I think it's so important to get into the game, right? Because you could have 20% down on your next house purchase because of the equity that we grew in the first house purchase, right? You gotta get in the game. Getting in the game, if it's very low down or 0 down, is a way to get in the game.
I have a lot of buyers that do have the down payment. They have it, but they want the 0 down payment program because they think that is probably the best. I mean, can you show them numbers? Listen, if you use the money that is sitting in your bank doing nothing, because sometimes it's doing nothing, versus putting it as a down payment, you can show them the numbers to make the wise decision.
Absolutely, yeah. Anytime somebody's in the low to no down payment zone, we're always showing them a 3% down conventional, 3.5% down FHA, those are their minimum downs, and then a couple of down payment assistance products. Oftentimes, the down payment assistance product has a little bit higher rate, so your payment's a little bit higher. But I just did one yesterday, and the rate was within 1/8% of a standard down payment loan. So in this case, it actually made sense to do down payment assistance because this guy's also buying a little bit of a fixer, right? And so he wanted to use the money he had for his down payment as fix-up capital,
right?
Which is great.
Yeah. Private mortgage insurance, that it's the PMI, right?
Yeah, that's right.
And it's because of this low down payment. But can you explain the buyers? Can that be removed?
Yeah.
Is that forever until they refinance? When can they get rid of that?
Yeah, a lot of people have that same question, right? So at any time with any loan, you can always refinance out of mortgage insurance, right? So if the value goes up and maybe rates come down a little bit, a refinance could make a lot of sense. But there are some products that allow you to cancel it and retain the mortgage that you have. That's a really good thing for somebody that maybe bought in 2020, 2021, where they got this super duper low rate, right? A 3% rate. Because if you're sitting on a 3% rate and you're paying $200 in mortgage insurance, you're not going to refinance to get rid of that mortgage insurance, right? You're going to keep that super duper low rate.
Yeah.
But if you have a conventional loan that you bought in, let's say in 2020, rate's great, property value's gone up, a conventional loan you can petition to have that mortgage insurance removed. And it's probably just as simple as going onto your servicing website and pushing a button. And then they'll do an automated valuation, an electronic appraisal, and probably just remove it, right? Snap it like that, and it's done. If the automated value doesn't come back in high enough, then you can order an appraisal.
Right.
Maybe you've done some work, right? And the automated just doesn't know that you put in, a new kitchen and a new bathroom, but an appraiser would, right? So you can get rid of it that way. An FHA loan, it's for life. You can't get rid of the mortgage insurance if you put minimum down. But if you did that and you got a 3% rate, the mortgage insurance is 0.5% per year. So you're effectively, your rate plus mortgage insurance is 3.5%.
So leave
still
it
better than the 6 or so.
Don't touch it.
Yeah, leave it alone.
Don't touch it.
But if you have a rate from a year or two ago and your rate was 7.25%, and you're paying 0.5% in mortgage insurance, now your rate plus mortgage insurance is like 7.75. You should definitely be refinancing, and we'd love to help.
Yes. Well, we can be here for hours, Cody.
Always.
Thank you so much.
Yeah.
There is so much information, so many programs out there. Any other special programs that we didn't talk about that you want to tell?
Yes, I've got one more that I'd love to share. I mean,
Okay.
you're right. We've got thousands of different options, but
Absolutely.
one really cool one is that we've got it's a buy before you sell product. So sometimes right now people are feeling a little stuck, right? They've got a house and it's okay, but they really like to make a move, but they can't get a contingent offer accepted, right? Because that's difficult. And they don't want to put their house on the market and sell it and have no place to go and be homeless, right? And so we have a product that will basically ignore your existing home mortgage payment, only qualify you on the new mortgage payment, and allow you to make that move. Okay. If you have a ton of equity in this home, we can tap into some of that in a line of credit for the down payment on the next one. And it doesn't count the line of credit against you as well. The only caveat is you've got to sign an agreement that says you're going to list it within 3 months, right?
Okay.
So you're going to have a listing. If you need longer than that, or you don't have the ability to get the line of credit, we have another product that will do the buy before you sell, and they will give you up to 75% of the value of your home minus your existing mortgage for down payment capital on the new one. They'll set aside 6 months worth of payments on the old house as well. So you truly, and they don't charge you for the loan that they give you to get the equity out. So there's truly no payments on the old house for 6 months. And they give us the down payment for the next one, and we just qualify it on the next one. I've done a bunch of those this year. They're really valuable. The one that we're really like on top of that too, it's kind of a bonus on top of the buy before you sell, is a 40-year fixed with the first 10 years being interest only. Okay, there's a lot of talk about a 50-year mortgage, right? Possible 50-year mortgage.
Yeah.
I did the math on it, and on an $800,000 loan, the 30-year fixed versus the 50-year fixed would cost you about $300 less on the payment. That's all. It would be about $300 a month savings. But the extra interest cost over that next 20 years beyond the first 30 is over $1 million. Over $1 million in extra interest cost. Okay, so the reason why I say the 40-year with the 10-year IO or interest only, the cool thing about interest only is if you make a principal payment, your monthly payment immediately adjusts. So an example is, let's say you take $1 million loan, okay, and your rate's, 6%, right? That 6% would be a $5,000 a month payment on $1 million loan. If you then sold your old house and had an extra $500,000 to push the balance down on the new loan, now your balance goes from $1 million to $500,000. Your rate stays the same, but your payment adjusts the very next month.
Okay.
So you had a $5,000 payment, now it got cut in half to $2,500. So you end up with the payment you would have got had you sold your house first, the very next month after you sell your house.
Wow, that is amazing.
Yeah.
I'm sure we kind of covered quite a bit, and we'll probably have a lot of confusion right now. And it's like, okay, this is a little much. How can our clients, whomever is watching this video, can get a hold of you to ask you for anything, any questions?
Absolutely. Yeah, we'd be happy to be a resource, even if it doesn't necessarily translate into a loan right now, or maybe you're in the loan process and you're getting some bad advice or you're worried about that. That's okay. Like, our job is to provide this information. I get paid for doing loans, right? So I love to provide the information. We love to educate. And of course, I like to put food on the table too. So if there's an opportunity to help, we'd love to help. If it's just informational and you need something right now, reach out. Wherever we post, you will have the phone number. I'll give you a scheduling link as well too. I can do a 15 or a 30-minute consultation. They can pop on the scheduling link and book some time with me.
All right. Well, thank you so much.
You bet. Thanks
Happy
for having me.
holidays, everybody. And
Take care.
we'll keep in touch.
All right.